Hotels, we all stay in them, we all hate them. Once in a while we love them. Let's go to David Loeb with Robert Baird in Milwaukee. Great to have you here.
My pleasure, Tom. I like them.
You like hotels. You look here. Let's look at the note first. Bring up a research note from David Loeb. Hospitality, New York City was the first market to recover and has begun to bump up against much tougher comparisons. Why did New York City recover first?
New York's an interesting market. First of all, it is essentially undersupplied. So New York sells out many nights of the year, 250 nights a year. New York sells out. So it's the first to recover because it's where a lot of business is done. A lot of companies send people on the road back to trade shows, back to meet their customers. They come to New York. On top of that, international travelers always have New York on the top of their list when they come to the U.S. So it's one of the first to get increased demand. It doesn't have enough supply. That leads to sellouts. That leads to rate increases.
David, which size or quality of hotel makes the most money for shareholders? Is it Motel 6 or Motel Cease, we used to call it? Or is it like mid-range? Is it Marriott? Or is it like leading hotels, the hotels I used to be able to afford? There's a hotel in Paris that used to be $350. It's now $800 to get in the door. Which hotel is where shareholders make money?
Surprisingly, I think it's the middle market hotels that can command enough rate and have very high margins that are the most profitable. So I think you're asking the right question, and I love the fact that you refer to Motel 6 as Motel C since it's owned by a French company at core. But in the reality, it's an urban or suburban select service hotel like a Courtyard or a Holiday Inn Express that's going to have the highest margins and have the highest returns for shareholders. They're the least expensive to buy relative to on a price per room basis, and they have very high yields on that investment.
Let's look at hotel construction. This chart blew me away back to 2002. Hotel construction, and there's no exaggeration here, off a cliff. I mean, the Census Bureau has this series, David Loeb. Is it really that bad? Is the construction of new hotels gone down that much?
Bad is a matter of perspective. For owners of existing hotels, it's that good. Financing hotels is very hard to do. There are very few lenders that are willing to make construction loans today in any kind of commercial real estate, and I think least of all hotels. So that means that supply will be very muted, and it will take a while for that supply picture to ramp up. That is really the core to our thesis on the hotel stocks, why we think they're going to outperform over the next few years. We think we'll have decent demand and a very favorable supply outlook with very little new openings, except in a couple of markets, including New York. But other than that, I think that's going to lead to strong occupancy gains and very good pricing power over the next several years.
Do they make money on minibars? I mean, this is a serious question. Do they make money on minibars?
Yes, it's a serious question. The answer is yes, not as much as you'd think given the pricing, but that's a very high margin item. It just takes a lot of labor. You have to send somebody to every room to check the stock every day. But yes, at those prices, they're making money on the minibar.
I love your research item. This just came public. There used to be a time, folks, where there was like 435 IPOs every day. Now they're by appointment in INN, the Hotel Combine of Sioux Falls. Bring up chart 3, Rex, if you can get your finger on the button there. There it is. Clean governance from Sioux Falls. Summit Hotel Properties. It came near 10. It's near 10 now. And you're loving this thing up 30%. Why should we pay attention to the hoteliers of Sioux Falls, South Dakota?
These people in Sioux Falls, aside from being good Midwestern folks, very solid corporate governance, the reality is they are buying those hotels in the middle market. They're buying these hotels that are very high return. We think they can buy assets with an initial yield of 8.5% to 10%. Their cost of borrowing is 4.5%. So you'll immediately get 400 to 550 basis points of spread from those acquisitions, and we think the market will favor that. On top of that, nearly half, 44% of all rooms in this country fall into the categories that they're going after, and yet they're the only public company that has scale that's buying in those markets. That's select service, what we call upscale or upper mid-scale hotels. And those hotels are capital starved. The brands are pushing them to upgrade the quality of the rooms, so they need renovations. The owners in many cases have little equity, and the only way they can get out of those hotels, the only way they can tap that equity is to sell. And Summit is there as a consolidator in what's really not a competitive market.
There's a hotel, David, I don't know if you know it, it's unfair to you if you haven't been there. It's on 44th Street, I believe, in Manhattan, called the Lamb's Court. I can't imagine the money that was put into this palace. I had breakfast there, and it is just phenomenal. Do those trophy restorations, do they ever make money at $600 a night or whatever?
Rarely. And I think when you do a trophy renovation, you better be able to command $600 a night, because you're going to pay a fortune to get to buy that space in New York. New York may be the one market where that works, because you can get high enough rates, you can sell out often enough. New York's a 7-night market. Most hotels sell out at best 4 nights a week. So New York has the best chance, but outside of that, it's very hard to make it that way. And you hope to make your money on the sale, on the real estate, that you can sell it for more than you put into it.
So that's important. You make the money on the real estate sale, not on the operating of the hotel.
That's right, and that's the opposite of middle market hotels, where you may sell it at the same price that you bought it, but you're able to glean a 7.5%, 8% yield going along.
I want to bring up this final chart, because I love this jargon. Talk about jargon, Rex. Get up the jargon button here. Hotels in search of RevPAR. This is like the land of David Loeb. What is RevPAR?
RevPAR is revenue per available room. All it is occupancy times average daily rate. So it tells you the amount of revenue you're getting for any room that is being offered for sale. So it's essentially a same store number. It's what we use to say what's the revenue of one room and how is that likely to change over the course of a week, a year, on a year-over-year basis.
Right. David Loeb, absolutely fantastic. Thank you so much.